Ready.
Hi, I'm Isaac. Matthew.
I'm Jack. I'm Connor.
We're gonna be talking about a stock that's already in the fund, Google. It's a slide I'm sure you're familiar with, but a little outline of our presentation. We're gonna do a business overview, breakdown of the revenue, the risks, financials, two key growth drivers, a little bit of our valuation for how it fits into the portfolio, and then our recommendation and summary. So Google is a tech company that began as a search engine and has a global service reach. They've obviously branched out into more services and revenue streams such as advertising, cloud computing, streaming services such as YouTube TV, and email. They classify as a communication service stock in which we are overweight, with the Spellman fund being at around 19% compared to the S&P 500's 8%. And our benchmark, we want to be within 5% of that.
So we are recommending selling 90 out of the 180 shares. We believe that the stock is currently overvalued and we expect negative returns in the next year. Google does not pay dividends, so this is not the reason to sell only half the shares. Google is currently trading at 107, and through our analysis, we expect the target price to be 104, which is a negative 3% return. Google provides cloud advertisements and email services, which majority of their revenue comes from the advertisement, and that's their first key driver. And the second key driver is cloud computing. Google was first time profitable in that driver for the first time. And this is the reason why we are recommending only selling half, because we believe that there's room for growth in this industry and many other opportunities. And two risks that Google faces are the AI development race. A lot of their competitors are investing a lot into AI. And lastly is the antitrust lawsuits that Google is facing and that they had in the EU and currently facing in the US. And so we invested around 4,200 back in 2008. And since then, we've had over a 1,300% return. That is largely due to the large increase in the past 6 years. COVID had a minimal impact on their stock performance. Now looking at the PE ratio, it's declined since 2020. And we believe this is a concern because as value investors, typically we like a low PE ratio, but we believe this is part of investor confidence in Google being low.
All right, and then looking at their revenue, obviously Google search takes up more than half of their total revenue, with YouTube ads also contributing about 11%, and then Google Network being the framework for their advertisements, taking around 12%, and Google Other and Cloud taking around 10% of total revenue as of 2022. And to break down revenue even further, advertising as a whole takes up around 80% of their total revenue and has had a little over a 19% growth rate over the last 5 years. And then Cloud, as stated before, taking around 9% of revenue, but has a much higher growth rate of a little over 45% over the last 5 years. And looking at that broken down year over year, even though this top one is Cloud, even though it is higher, they do have a downward trend over the last 5 years. And same with Google ad revenue, even though it did have a spike in 2021 coming out of COVID, it shot back down in 2022 and is continuing that downward trend in growth.
So overall, we rate Google a neutral stock. Some of the pros they have are strong environmental goals like water reduction and electricity reduction. Also, they have very strong minority programs. However, some of the cons they do have are DOJ lawsuits, a bunch of privacy concerns, and a strong EU anti-lawsuit as well. You can see below, here are some of the examples of the pros and cons. I won't go into it in depth currently.
So now looking at the risks that Google will face in the future, I want to highlight the top 3 that we kind of figured are the highest probability and highest significance of risk for Google. The first being the AI development. As Connor kind of talked about earlier, we consider Google to be in second or third place for the AI development race. Microsoft has a large investment into ChatGPT and OpenAI. And their capabilities and software is a little above and advanced of Google's Bard. And there have been a few reports that Google's Bard has answered a few questions wrong compared to ChatGPT's OpenAI. And the second risk with the most prevalence and the most significance of risk is the DOJ antitrust lawsuits. The most recent one we kind of discussed was the lawsuit out of the Washington state. They talked about a DOJ lawsuit breaking up the online advertising industry because of the monopolistic tendencies that Google has. And then the third risk that we think is the economic performance in the future. With the uncertainty of the future, the jobs report came out today and was pretty solid, but there are still some factors I'll touch on a little bit that could kind of cause uncertainty with the economic future as well.
Now looking at the competitors, so we looked at Amazon and Meta just because they're Google's largest competitors. These are the 2022 numbers. Amazon actually had a loss in 2022, and this is because they invested 57 billion into cloud computing. And now I want to point out the ratios that are circled, the ROE, ROA, and net profit margin. These have all decreased since 2021. Although they're still above average, this is still concerning because they aren't as profitable as they once were. And it's concerning based on the competitors growing as well.
So moving into our first growth driver, that's Google Cloud. And just a brief overview is kind of hard for me to understand what cloud is too when I was looking into it. It's kind of a little bit over my head, but just a high level, it's kind of data analysis and storage. So people personally and businesses will use Google's technology in their computers to kind of make their processes more efficient. And this has been a big growth opportunity for them, although it still is a small part of their earnings and revenue. They just posted a little over 10% revenue this most recent quarter compared to their total revenue. And just looking at the cloud market overall, you can see in this figure to the right, the cloud market has grown significantly. This graph is from 2017, so you can see it's quadrupled in size. And there's really been two main companies that have established themselves in this market, Amazon and Microsoft. And Google's kind of hung around third place, but still Amazon and Microsoft hold 5 times the market share as Google does right now. And looking at this table to the left, you can see these companies are just investing so much more in cloud than Google, and Connor mentioned that earlier as well. Amazon's not seeing a profit right now, but they're really investing for the future, and Google's trying to keep up, but they still have a long ways to go with this market. And as Connor also touched on, they recently saw a profit for the first time in their cloud segment of just over 2%. So that's notable as well. So looking at what we project for cloud for Google going forward with their revenue, looking at the bottom, we project 27% revenue growth in this segment through 2026. And that follows a similar trend that we have seen Google's revenue grow at the past couple of years. And how we calculated that was first looking at industry projections. So that's around 18% through 2027 at a constant growth rate. And then we also took a market share weighted average of the top 3 players in the market, and just looking at their past revenue growth. We wanted to include the top 3 players just because Google is one of those big players. And we think that these 3 companies are just growing significantly more than the overall market. So we weighted 60% on past growth, this 33% number, 40% on industry projections, giving us our 27% going forward.
To get started, I'll point out the 3 different colors down here. This is television ads, digital display ads, and newspaper, going red or blue, red, and gray. So first, I'll point your attention to the top picture. Our second growth driver is Google advertising. And Google advertising is a part of the digital and technological sector. And you see up there, it is more economically sensitive. So depending on the economy, it can benefit Google or negatively benefit Google, because it represents like Matt and Jack said, over 80% of their revenue. The second picture points out how the digital ads have increased at a high rate from 2010 to 2022. We bought Google around 2008, around $4,000. And the industry as a whole has seen at most 20% increases between 2010 and 2020. However, recently, the industry growth rate has stagnated about 14%, which means Google no longer experiences the high growth rate it used to have, showing a slower growth rate in their revenues and profits as well. Next, these are some key situations and considerations we took while evaluating Google. Like I stated before, the average industry growth rate that we found and projected were around 10% to 14%. We did this by incorporating the new internet access around the world, Google's market share, and then overall industry studies. Next, another big player in Google's growth is their reliability on YouTube. With the new Sunday TV ticket package, they're going to gain an exponential amount of advertising through the games and subscriptions, more than millions of people outside of what they previously had on YouTube. Lastly, another big thing that we considered was Google is currently losing market dominance as a search engine. For the past 4 years, they have steadily declined from 84% down to 80%, with Bing quickly catching up with them at around 12% currently, or growing to around 20% projected. This is because they have a stronger ChatGPT model than Bard's and other uses that Samsung, for example, is considering replacing Google with Bing as their main search engine. This will lead to billions of dollars of losses for Google and loss of advertising. We project Google advertising growth rate for the next projected years are at 17%. Like Matt stated before, we took an industry average of 3 major companies and their market share. For that, we got around 20%. So what we did was average their 20% in the market with the industry's 14 to get 17%, which you can see down below has remained pretty constant with the past 5 years. It also represents the flattening of the growth curve in the industry. So Google will no longer see the high 20% like it used to back around 2010 to 2020. On top of that, we will next talk about EPS projections.
So now, EPS projections. So the baseline EPS for 2023 for Google search is a little over 5. And then within that, there's an optimistic scenario and a pessimistic scenario. Optimistic is just outperforms the market and gains even more market share. And then for pessimistic, competitors take market share. Like Mitchell mentioned earlier, Bing takes some of Google's revenue. And then also with ChatGPT taking away shares or taking away searches, which will ultimately impact their revenue.
Now looking at our total earnings per share projections with these revenue growth rates in mind that we stated earlier. One thing I want to mention right away is that search is just such a big part of earnings for Google, and that makes them more risky than a lot of other companies just because they're putting so much into that one segment and just kind of over allocated in that way. And as Connor stated earlier, those kind of our earnings growth projections for search is really the main driver for our total earnings. And you can see we're projecting around 20% growth each year. I want to mention that from 2022 to 2023, we're projecting a little bit more earnings growth, and that's just because they recently announced a $70 billion share buyback in their most recent earnings release. So that's the reason for that numbers there. And you can look at cloud too, as I mentioned earlier. Although it's growing significantly and they recently posted a profit for the first time, at the end of the day, it's still such a small part of earnings, and we don't project that to change anytime soon. So looking at our target price and target return, we weighted 80% on our PE estimate and 20% on the free cash flow estimate. The reason for that was just because the PE has been more accurate in predicting Google's stock price historically. And so I want to mainly focus on our PE estimate all the way to the left here, and we project PE to go down, just because we think investors will be less optimistic on Google for the future with these AI risks, and a lot of news taking place there. And right now, the market and just kind of people in general associate AI search with the name ChatGPT. And if this becomes a bigger player in the overall search market, then that can really be detrimental for Google long term. So that's why we're projecting lower PE estimates and a much lower pessimistic view, because this is a real risk for Google. And that brings us to our target price of around 104, giving us -3% return.
So now moving into the portfolio fit. On the left, you can see the portfolio correlation matrix, and it's highly correlated with its three largest competitors of Microsoft, Meta, and Apple. Stock is positively correlated with every single stock in the fund, and positive correlation means that when the stock price will go up, the rest of the stock prices will go along with it, and they are sensitive to each other. So we don't really look for positive correlation, we kind of look for negative correlation, and given the fact that it's positively correlated with every stock, looking to liquidate some of the shares in that. And then for the Spellman fund in general, it's about 0.076% correlated with Spellman fund in general. And then, as Isaac stated earlier, the Spellman fund has 19.09% weight in the communication services. The S&P 500 has roughly 8%, and we're trying to get into that benchmark of the 5%, which is why, you're going to go to the next share. We recommend selling half of our shares. Overall, the online advertising industry is highly competitive. Amazon and Microsoft are gaining a lot of market share in the online advertising industry. And as Matt and as Mitchell kind of talked about, the advertising industry is economically sensitive, and with the future of the US economy in question, the stock price could be in question as well. And then for the AI development race, we pictured that to be Google's largest risk, as they are currently losing the AI development race to Microsoft and ChatGPT, along with the Bing competition as well. And then looking into the future of the US economy, we're kind of in question with that, with the jobs report just having to come out and posting strong employment opportunities and low unemployment rates. We're kind of looking to see what the future of the US economy could hold. We don't really know whether or not it's going to be a recession or a positive outlook, which is why we recommend selling half as well. And then for cloud computing, Matthew touched on how they finally posted a profitable quarter, and they are still in the third place for the market share, but we see a little bit of growth opportunity for them. Again, we recommend liquidating half of our shares. We see a little bit of positiveness for Google in the future, but the outlook remains kind of pessimistic for us. And if we do sell half of the shares, the 19.09% would go down to roughly 16.03%. And the little under 5% weight holding in Google currently will go down to roughly 2.5%. And at the current price of 107.34, liquidating the 90 shares will give us a little over $9,600 in cash. And then again, as we all talked about, our target price is the 104.12. And then if we sold right now, it would be a negative return of roughly 3%. So we want to thank you for listening to our presentation. And now we're going to open up into questions for the group.
If you think it's gonna go down, why not sell all?
Well, with that, we kind of, cloud could gain a little bit of traction, and with Google being the largest dominator in the advertising industry, it will take a little bit of time for more competition to kind of catch up to them. And we do see a little bit of profitability in that kind of instance, but that's kind of what we think about why we wouldn't liquidate all of the shares.
And if I can add on to that, a -3% return is still a loss, but it's not a big loss, and we do still see solid earnings projections for them. So the main reason why we want to sell is just to mainly reduce holdings in that sector and to reduce the risk of the overall portfolio in that way.
Go to your risk slide. I think that was page 9. So we talk about AI development as the biggest risk. So that's the search.
Yeah, that's like incorporating it into the search protocol and what kind of Microsoft and Bing is doing as well.
So what's the population of Italy? How'd you find it? Right, you Google it.
Yeah.
You're still not gonna bang it.
Exactly, yeah.
And then FX risk, how much of the revenues come from outside of the US? Did you have that breakdown?
Do we have that in the earlier slide?
Yeah, for split between US and
No, then I don't know if we know what comes from
All right,
other countries.
so that was a big headwind through 2022. US dollars declined by about 10% since November. Outlook is probably for a continuation of that, so Forex risk become probably a tailwind rather than headwind. But I love that it's on here as an FX guy. Antitrust lawsuits. I often hear that Google is, you'd almost be better off with the sum of the parts than the whole. So if there was a negative outcome to an antitrust lawsuit, and all of a sudden you owned search, YouTube, whatever other business units that they're working on this week, that, you know, the old sum of the parts is greater than, you know, whatever that expression is, but you'd almost be better off if it broke up. Do you have any thoughts of that as you were looking at the individual business units going, geez, if we just broke out YouTube, it would trade at a 30 PE. If we just broke out search, it would trade at a 30 PE. But if, because we do it all combined, for whatever reason, the market gives it a 19 PE.
Yeah, I think that lawsuit, if you want to go down the lawsuit page, is mainly for advertising, because they're the search engine, the provider, and the servicer. One of the quotes stated is like if Goldman Sachs owned the New York Stock Exchange, they basically would own the entire chunk. So what the DOJ is trying to do is just break it up so more competitors can get inside the industry, because currently they own over 80%. So that's going right here. They're just alleging monopoly in the internet search. So that's not on the YouTube or any of the other sides. It's just the search and advertising.
So it'd be splitting search from their assets.
Yes, it was kind of confusing to read because it's all incorporated into one. They didn't necessarily describe the specific steps. It's just they recognize it's a monopoly, and so did the EU in one of the other cases that it basically squashed a lot of the other competition in smart businesses over in the EU. So the DOJ was trying to follow up with that as well.
Did you purposely always refer to it as Google instead of Alphabet? Part of the conversation.
Yeah, I think Alphabet, it's like the parent company, right? And Google is like 90%, over 90% of Alphabet. So that was our main focus. And just it being so weighted on search, that's just kind of our tendency.
More of a joke, but I could see how your negative connotation to the search part, maybe you want us to pay more attention to that than the other business. Speaking of the advertising, so if we're expecting a decline from search, they seem to be having a gooder opportunity in YouTube. What are the profit margins? Do you have that for those two individually? What I'm trying to get at is if they lose revenues from their search, but they gain revenues from their YouTube, are they gonna have the equal amount of earnings at the end of the day?
I think there was.
A little bit on YouTube, their advertising has struggled. So outside of the NFL deal, it has gone down drastically. So it will make up for the search pieces. Down here, it still is a fraction of what search was overall producing. Is there any other slides on that you comment?
If you go down one more. So these are kind of what we're projecting for the profit margins for cloud. So I can give you an idea for that segment. But as I mentioned, it's still only less than 1 earnings per share. I think this is in either millions or billions. I can't remember for earnings per share, but just compared to where we're projecting around 10, it's like a 10th of where we project their earnings. So search just being 90%, if that goes down, their total earnings is going to go down to kind of put it plainly.
Can you go back to the all the various calculator, basically where you had Facebook and Meta as the competitors,
Valuations.
yeah, the valuations or the calculations and all that jazz. 'Cause you- So there's a trend that you guys pointed out. I'm kind of wondering if you guys know why the trend is going on, like why has the ROE been in decline? Why has the ROA gone down? Why have margins compressed? Like what's driving that? You guys have any idea?
My guess would be because they're in the early stages of cloud and that they've been investing a lot, just haven't seen the return yet. And in future years, they probably will see that return, but that's just my opinion.
Yeah, I mean, in earnings calls, they've really put a lot of emphasis on cloud, and there's been a lot of, in the Q&A, a lot of analysts are asking about cloud and the profitability of it, and just first, seeing that initial profitability this quarter, we could possibly see those numbers come up, and that's definitely plays into why they're decreasing, just because they were investing so much at first to try and gain some of the competition with Amazon and Microsoft.
But now that I think about it, you kind of already told us the answer in the appendix slide, right? What was the cloud margin?
This quarter is around 2.5%,
What's the margin there? That you got circled?
21%.
It's less, right?
Yeah.
So if that kicks, that could be your answer. And then I guess the follow-up question is, if that's the case, did you happen to do any research on what the margins are at Amazon and Microsoft?
For cloud.
Yeah.
Microsoft most recently was around 43% profit margin. Amazon was around 30. I don't have that listed anywhere, but I just looked into it the other day. I
I like
remember.
where we're going here.
And so
How does that compare to that number?
it's definitely higher, but something long-term possibly for Google Cloud.
So that's a potential positive. Huh, interesting.
So I think in your appendix, you had, thought I saw like 16% was the, whatever you stopped it at. Do you anticipate it getting to the competitors' profit margins, or is there a reason why they're gonna have a lower profit margin than their competitors?
Personally, I viewed it as being lower just because, maybe if you go back to my first cloud slide, you can just see how much Amazon and Microsoft are investing, and they're just investing almost twice as much as Google, and Amazon and Microsoft have kept getting bigger as the market grows, and Google is they've gotten bigger, but they've maintained around the same, first, second, third place, and I don't really expect that to change. I just think Google will become more profitable now that they're finally, have a decent amount of market share in cloud. I don't know if they'll ever get to where Amazon's at, just because Amazon has such a head start, and but that was just kind of my opinion, really, when doing some research.
So Amazon is 34% of, call it 60. So they're 20 billion in revenue, 57 in expenses, and that's a 40% profit margin.
Microsoft was 43%, Amazon was around 30.
Did you see where my numbers, where this doesn't line up?
That's quarter.
Yes,
Quarterly, annual, got it. Is that still at 2080? 57 out of 8.
I just, on their most recent, annual financial statement for cloud specifically, it was around 30% profitable.
Yeah, that doesn't add up for Microsoft. 21% of a $60 billion market.
But it's expensive and revenue. Two different.
Right,
But he's trying to do the margin.
I'm trying to get back into it because Amazon, that kind of almost works, but when you take 21% of 60 billion, 12, so 48 billion in revenues, 42 billion in expenses, that doesn't equate to a 43% profit margin. That equates to like a 9% profit margin for Microsoft.
This is a little, quarter 3, 2022 is a little outdated. It's the most recent research that I could find.
Yeah. Well, and this is 2022 expenses. I just wonder if it's expenses or investments, and is it the same? I don't know. I don't know the answers. It just seems like they're spending an awful lot of money chasing revenue. And then same now Google, 11% of, again, 60 billion. Comes out to somewhere in the neighborhood. You doing that too? Casey?
We use a calculator.
Why would you do that?
It could
It's
be,
like 27 billion in revenues and 29 million expenses, so have it. So,
Let me ask AI.
hey, Bing. So I think I'm good on Amazon and Google, but the Microsoft expense number doesn't line up with the revenue number given the margins. But I think you're right, because they always brag about the margins at Azure.
it could be a way that they're reporting it on their financial statements too. Cause I was
There's
just,
other stuff getting dumped into this bucket that's not part of the cloud.
that's a good point.
Did you get those expenses off of those companies financially?
Yes, I just kind of, they allocated certain amount of expenses for cloud specifically. And again, that was annual data last year, so.
Who's number 4? Do you know?
Alibaba maybe, or Adobe. I'm not sure.
Because we've heard Adobe before, didn't know they're in the cloud space, but they're a big player. IBM got Red Hat, but IBM's late to the game and
They
everything.
always talk about their cloud game.
Do you think Bard would beat ChatGPT in like the long term at all? Like anywhere in your research, any features
That-
about Bard?
That's what Google's going with. They did have a lot of like controversies because it started in 2015 with their AI with Mina or Meta, whatever it was first called, but yeah, they had a lot of controversy in 2020, especially with like just a lot of internal stuff, especially when they had a deal with the military, which caused like some crucial people to leave the company that were part of the AI development. So they've just been really cautious before they've released their AI Bard to the public, but ChatGPT has kind of forced their hand into kind of developing something prematurely. So they're hoping to go for like the long term, having like a more quality product than like something that's flashy right now, like ChatGPT.
Much longer do you want to try to?
This will be a discussion at Dell's. I'm getting like 18%, I think this is like that, so it doesn't really matter.
I'm just curious, because I think
You're calling me a liar.
No, here's where you were getting at. It's at 2% now. These guys are at 40 and 30.
Yeah.
You would assume that you could experience similar or expect to end up in the same ballpark in terms of margins on this particular segment of your business.
Yeah.
So how can we grow this segment of business fast enough and get to a point where where Google does have 30% margins, in which case if your company margins are 20% and you're growing a segment that has 30%, you would expect margins to go up. You would expect that PE to go, the multiple that the market is paying would expand, and we would see this thing back towards 120. 130.
Easy dump in all that CapEx and all the CapEx is in place.
As soon as I sell it, it's gonna go. That's what's gonna happen.
All right.